In this pod, we'll look at how businesses use financial data to analyze their accounts. We'll be talking about balance sheets and income statements, so you might want to go back and watch our pods on these topics before you go any further.
There are a number of different calculations that businesses use to monitor their financial performance. But before we look at these calculations, we'll look at qualitative and quantitative factors. Qualitative factors are things that aren't just numbers and figures, they're reasons and explanations. Think of it as looking at quality information. It has detail to explain what's going on. It doesn't just give a quick number quantity.
So instead of simply looking at whether profits are increasing, a business would want to know the reasons why profits are increasing or decreasing, or what their profits are like compared to the market in general and why, or if the market is growing, should they be making more profit. Always remember that any statement on a financial performance is merely a snapshot in time and things can change rapidly. But these statements do help to make predictions and supply the company with past performance data.
Quantitative factors, on the other hand, look purely at the numbers. Think of this as a number quantity to help you remember. It will show that earning a profit of £2 million is better than £1 million, regardless of anything else going on. To examine these quantitative factors, a business will look at their income statement and their balance sheet first. But if we use qualitative data alongside this, we may see that they had a large investment somewhere, which may explain the doubling of profit, or they may have increased the price but sold the same amount. This is why often in business, we need to look at both qualitative and quantitative data to be sure we're getting a true picture of what the data is saying.
On the income statement, a business can examine their gross profits, their net profits, and their margins. We talk about how to calculate these in our income statements pod. The general rule of thumb with profits is the higher the better. You want your figures or your percentages to be as high as possible.
On the balance sheet, there are some additional calculations you can do. One of the most important is the current ratio. You take your current assets and divide by current liabilities. For example, a business might have £100 worth of current assets. This is something that can be sold to get an income. But they might have £50 worth of current liabilities. This is something they need to pay, like a loan, in other words, debt. 100 divided by 50 gives an answer of 2. This means the business can pay off its debts twice over.
If it were the other way around and the calculation was £50 of current assets divided by £100 of current liabilities, your answer would be 0.5. So you'd only have enough assets to pay half of your debts. The ideal ratio is said to be between 1.5 and 2. This means you can comfortably pay your debts, but you don't have loads of assets not being used.
There's also the acid test ratio. This is the same as the current ratio, except you take your stock away from your current assets. This is a stricter measure, and so your ideal answer is allowed to be as low as 1. Remember, for either calculation, if the answer is below 1, it means you don't have enough assets to pay off your debts.
You can also do calculations that use figures from both the income statement and the balance sheet. The most important is return on capital employed. As a quick reminder, capital employed is money you've put into the business, and return is when you start to gain a profit from that investment. There are some variations on this calculation, but in essence, it simply compares your profits to the investment. You take your final profit, divide by the capital employed, and then multiply by 100 to give a percentage. It shows you what proportion of your investment you make back as a profit in that year.
There are plenty of other ratios too, such as the inventory turnover ratio, which compares your cost of sales with your average stock level. But check which calculations you need for your exam board. We've only covered the main ones here. Finally, there are other quantitative factors worth looking at which can help a business analyze their performance. You may hear the term markup, which shows how much you're selling your product for above the cost of buying it in. Or you may see that a business looks at their marketing data, which means it looks at the information gained from their market research.
So to analyze a business's accounts, you could compare their profits, which should ideally be as high as possible. You could examine their liquidity, which is the current ratio and acid test ratio, where you see if they have enough day-to-day cash to function. Remember, if the answer is below 1, they can't pay their debts. Many investors look at the return on capital employed, which is a measure of how effectively a business turns investment into profit. Beyond this, there are many other ways you could interpret these accounts.